Hi, this is Jack Crooks from Money and Markets TV. If you've ever tried to trade the currency markets, you know how frustrating it can be. The price action on any particular day may have nothing to do with the news or the price action in other asset classes. That's because a lot of different types of investors trade currencies for a lot of different reasons, using a lot of different techniques. Corporations, financial institutions, equity fund managers, proprietary trading desks, and central banks all play in the currency markets every day, along with retail investors like you and me. In addition, these players may be trading in multi-year, multi-week, multi-day, or even intraday time frames, and they may be basing their decisions on fundamental economics, technical price action, sentiment, correlations, or other factors. You also have to take into consideration the fact that currencies are used for trading other asset classes such as stocks, bonds, and commodities. For that reason, currency prices often have tight correlation with other markets. Understanding those correlations and learning how to interpret any deviation could help you use the currency markets to your advantage. One intermarket correlation I look at often is the relationship between Chinese stocks and the Australian dollar. Historically, these two lines have moved consistently in the same direction. That makes sense because Australia's economy is so dependent on Chinese demand. But over the past 18 months or so, Chinese stocks have taken a tumble, while the Australian dollar continues to rise against the US dollar. There are several reasons this could be happening, but I think it boils down to the fact that the Australian dollar has been slow to react to the slowdown in the Chinese economy. So to me, the breakdown in this positive correlation represents a great investment opportunity, betting on a long-term decline in the Australian dollar. One example of a negative correlation is the usual relationship between the Dow Jones Industrial Average and the US dollar index. In other words, when US stocks rise, the dollar tends to fall, and vice versa. But recently, this hasn't been the case at all. Now the dollar generally moves higher along with the US stock market. This tells me that money is flowing to the United States for both safe haven and relative investment opportunity. We saw the same thing happen during the last bull market cycle from the early 1990s until 2001. Whether the dollar and stocks will continue to rise in tandem, we'll just have to wait and see. If you understand how intermarket correlations work, it's easy to incorporate them into your own style of analysis and give yourself a powerful new tool to help push the odds of success in your favor. I'm Jack Crooks from Money and Markets TV. Thanks for watching.